Spread trading. I'm sure sometimes you might have heard it in the news, or you heard your friends talking about it. The general type of trading that we're all used to is outright trading, where we take a security, we try to predict the direction of it through technical analysis, fundamental analysis, sentiment analysis, whatever it may be, and we try to predict the direction of the market. But another way of trading, out of the many that there are, is spread trading. Now, what is spread trading? Spread trading is the simultaneous purchase and sale of a similar security, e.g. bonds, stocks, or indices. It is a trade where we try to make profits from the relative movements of similar contracts. We're not concerned about the direction of the market, more the performance relative to each other. Generally, with spreads, we're looking for mean reversion. So what type of spread trades are there? Well, one of the most familiar spread trades is using calendar spreads. This is a sale and purchase of contracts from the same security but differing maturities. We also have butterfly spreads, which is the sale and purchase of spreads within the same underlying security. So we might have one calendar against another calendar that are next to each other, and that would be a butterfly spread. We also have intercommodity spreads. This is spread between two different securities but are similar in nature. E.g. we might trade the Euribor against the Schatz, which are both bonds, but one's a government bond, one's an interbank lending rate. So let's look at some example of these type of spreads. So we have short-term interest rates, e.g. Euribor, short sterling, or Eurodollar. Now, primarily, these are all very good calendar spreads. They have many different maturities, and ranging from September 12 maturity all the way to 2015, 2016, 2017. Now we can spread along this whole curve and look for relative underperformance or outperformance within this commodity curve, within this curve. We also have oil spreads. With oil, just like interest rate, there's different types. There's Brent crude oil and WTI, and they both have calendars as well with different maturities. But there's also the intercommodity spread in this as well, where you can trade Brent against WTI. They're similar contracts, but trade slightly differently, but they can still be spreaded. Amongst other commodities, we also have sugar, coffee, and corn, and these can also be spreaded. They have a range of maturities, and with the same way as interest rates or oil, we can spread them together. We can do butterfly spreads. This is all possible trading these. We also have index spreads. Now these are slightly different, where as we don't really have many different maturities, you normally trade the front month futures, but you can trade these indices against other indices within the same region. For example, the DAX against the Euro Stoxx, or the S&P against the Nasdaq. So with the S&P against the Nasdaq, for example, they're both two popularly traded indexes from the USA, and each with a slight subtle difference. Whereas S&P is more industrial stocks, we have the Nasdaq, which is more technology related stocks. Now if we think, for example, technology is going to outperform the S&P, then we'll want to go long the Nasdaq, short the S&P. So regardless of which way the market is moving, whether it be up or down, we'd expect the Nasdaq to outperform the S&P in both cases, thus leading to a profit. We also have equity spreads, and again these are trading two companies from the same sector. So if we look at the banking sector right now, we could trade Barclays against Lloyds, or RBS, or whichever it may be. Now for example, at the moment Barclays have been sold off pretty heavily amid this LIBOR scandal. Now if we think that Barclays is going to be staging a comeback, so some type of snapback, but you're too scared to maybe trade it outright, what we might do is hedge it with another bank which might have similar issues, and if we do get a rally, that would expect them to outperform. So for example, Lloyd's has been stuck in a tight range, so if we do get a rebound from Barclays, in my opinion, we probably will outperform Lloyd's, so we can hedge ourselves in that aspect. But if we get a general banking sell-off, then you'd expect Lloyd's to go down roughly at the same pace as Barclays, given the initial sell-off that we've actually had in Barclays, and that in turn will hedge our exposure to the downside. So let's look at a real-life example of this type of spread. So what I'm going to show you is a spread of in WTI, and we're going to look at a butterfly here, and what we have here is the November-December WTI spread against the December-January WTI spread. Now what we do, we spread them together by doing one minus the other, and by then we can get a chart of how it's been trading relative to each other over the past a couple of months. Now as you can see by this chart, which I'll just expand here, they've been trading very consistently. So if we look here, as I scroll back, it's been trading within these bands for the last couple of months, and the beauty about it is that there's not much you need to know about where you think the market's going. During this spread time, there's been loads of economic factors that have come in and come out, but yet the relationship between the two have held very well. And if we look between the range of this spread, we can see that the low is roughly -4s and the highs is 1s. So looking at this spread and looking at the historical probability, anytime we go towards these bands, we're likely to bounce back within this range. So right now we're getting towards the top of this range in this spread, so we're trading basically at zeros at the moment, and what do you call it, the highs roughly is 1s. So in this instant I'll be looking to have a short bias, where I believe that we're going to outperform in December, Jan relative to November, December, and in that, if this happens, then we'll go back towards our range and we'll nick a couple of ticks here and there. And if we get towards the bottom, we'll do the opposite, where we'll buy November, December and sell December, Jan, and again look for a move back up towards the range. So if you look at the individual contracts here, right now you can see that we're trading -46, -45 in the November-December spread, and -46, -45 again in the December-January. So what we try to do is look to buy maybe 46 and try to sell 45s to give us 1s over here, and then hopefully look for a move back down in the spread. So as you can see, it's a lot more predictable and it's a lot more safer to trade these spreads, because if we break out, then we might look to just get out and just take a small loss. So we don't have the normal wild volatility that you would associate normally with the markets, and this is why, in my opinion, trading spreads is one of the safest things around and gives you a chance to make it in this market more than in any other style of trading. Hope this helps. Until next time.